Okay, so imagine this. You're out shopping for a home with your family. You find your dream home. You want to buy it, right? But guess what? You can't. And why? Because you didn't get pre-approved first. We're going to talk today about the pre-approval process. We're going to talk about why it's important, what it involves, when should you start the process, what information do you need to give, right? It's kind of scary. You got to give all this information. What do I got to give? I got to talk to some stranger and give my personal information, right? So we're going to talk about all that stuff so that you understand what you're going into, how to be prepared, and how to better be more comfortable with this process before you go out and start shopping for a home. All right, let's just jump into it here. So this is kind of the road to your home ownership, right? There's several processes in the transaction. The getting pre-approved process, you see here, it's the first step on the road. There's 9 steps. You've got get pre-approved, find a property, the loan disclosure step, the appraisal, submitting to underwriting, initial underwriting approval, submitting back to underwriting for final approval or the clear to close, and then the closing, right? So there's 9 steps, but we're just at number 1. So this is just the very first step in the process. You're not even worrying about an appraisal at this point yet because you don't have a property to get appraised, right? You're certainly not worried about submitting anything to underwriting because again, you're not even ready to go out and start looking for a property. So the first step is the pre-approval. So what we'll talk about why you get pre-approved, right? You want to understand what is your price point, right? How much can you buy, right? If you can only afford $350,000, certainly you don't want to be out there looking at $700,000 properties, right? Or if you can afford to go up to $700,000, and then you don't want to feel like you're limited to $300,000, $400,000, right? So you want to understand what are your limitations? How much can you afford? How much will the lender approve you for when it's time to go through that process? You also want to show the parties here that, and when I say parties, I mean real estate agents basically, because you're going to have a realtor, the seller is going to have a realtor on the property that you're looking to buy. You want to show them that you've actually done your due diligence by talking to a lender, such as myself or anybody else, to make sure that you've given them the documentation and the information that's needed so that they can do their work and tell you how much you're pre-approved for so that everybody feels comfortable that if you make an offer and the seller accepts the offer, that this is actually going to close and that there's not going to be any problems. And then finally, but probably the most important, especially in the market that we're in right now in June of 2023, is that you need to be ready to make an offer. So if you go to make an offer on a property and you don't have a pre-approval letter, that seller's agent, the seller, they're not even going to entertain the idea of your offer because there's probably going to be several other offers on that property, which is very common in this day and age, in this market. So you want to have that letter with you so that you're ready to make an offer. If you find that dream home, you got to have that letter so that you can go ahead and make that offer at that time, which you can't do without the letter. So let's talk a little bit about what a pre-approval is. Okay, so it's basically just a letter from your lender or your loan officer that says that you're qualified. And then it's going to explain what your qualifying factors are. So like how much you're pre-approved for, what type of loan are you getting, what term of loan? Is it 30 years, is it 15 years? Is it a government loan like an FHA loan? Is it a conventional loan? How much money are you putting down? They look at that stuff. The seller wants to know how qualified you are, right? So this is going to lay out the details of what type of a loan you're getting, what type of financing, and all the specifics around that. It's going to also list the documents that you've provided your lender. So it's going to say, the lender's going to put in the documents, say, we've reviewed income documents, we've reviewed bank statements, we've reviewed, the credit, everything like that. And so that, again, is important to the real estate agents who are going to see the letter because they want to know, did you actually provide this information or did you just call up some bank and say, hey, I've got good credit and I make good money. Can you please print me a letter? And believe it or not, there's banks out there that will send a letter without doing any due diligence at all. So this letter is going to say, what did the lender do to make sure that you're actually qualified to make this offer and that there's not going to be any problems if you make the offer in getting you the loan? And then it's going to also say the lender information on the pre-approval letter. That is also very important because all lenders have reputations, whether it's a bank or a credit union or a mortgage broker or a mortgage banker. Everybody has reputations, and certain lenders are not seen as being as reputable as others. Certain types of lenders are not being, seen as reputable as others. A lot of realtors like to see a local lender on the pre-approval letter, as opposed to some, online lender that might be in a completely different state that doesn't really know much about your particular market. So this is all going to be on the pre-approval letter. It's all super important in terms of conveying the information to the real estate agents in the transaction and to the seller that you're ultimately going to make the offer to. All right. So when do we want to get pre-approved? This is kind of depends on the situation, right? So ideally, the sooner the better, because the sooner you understand how much you qualify for, then the better, and you can, work out any kinks. So like if there's something about your income or your credit or where your funds are coming from for the down payment that need time to get fixed, or whatnot, then, the sooner you get pre-approved, then the more time you have to take care of those things before you're ready to go make an offer on a property. Especially if there's challenges. So like if you have, credit card debt and you need to pay it off, right? Well, that could take time to reflect on the credit companies, for them to actually report that to the bureaus, right? Or if you had a bankruptcy, there's waiting periods, foreclosure, short sale. You can't just go buy a house whenever after one of these events. You have to wait a certain period of time depending on the type of the loan that you're getting. So again, your lender's going to go through all this. They're going to look at your credit. They're going to see what your credit history is like. And so the sooner you talk to that lender, the sooner they're going to be able to get eyes on your situation, on your credit, and then fix any problems to get you in the best position, not only to be able to buy a house, but obviously to get the best terms, right? To get the best rate, to get the best program, the lowest monthly payment, right, for your situation. Documents are typically only good for about 3 to 4 months, depending on the type of loan that you're getting. So most pre-approval letters will say, like 90 days, this is good for. It doesn't mean that, if it expires, it doesn't mean that you necessarily have to go fill out a whole new application. Like we, for instance, will keep our borrowers' applications on file. And then if a pre-approval letter expires, we'll just look at what documents are outdated. So if it's the credit report, we just may have to just pull another credit report because, maybe it's been 5 months since we did the pre-approval. So we need to just make sure that nothing new has shown up on credit that could potentially change that pre-approval. So, if you think that you have excellent credit, your income is very straightforward because, you are on a salary at a company, you've been there for 10 years, and you've got plenty of funds in the bank and you haven't been moving money around very frequently, then you're probably okay waiting until you're within that 90-day period to do the pre-approval letter. But again, if you think there's challenges, credit, whatever it might be, then it's probably better to talk to someone earlier, even if credit might have to be pulled, once or twice in a 4 or 5 months period, which, typically isn't really that big of a deal. And then basically, the timing thing. So a big no-no, which happens, believe it or not, is making an offer without a pre-approval, right? So the number of times in my career that it's, I've received a call on a Sunday from someone who said, my realtor told me to call you. I'm under contract on a property and I need a pre-approval letter. Well, okay. Now you've already started the ball rolling on the transaction and we have no idea what your credit looks like, what your income looks like. Is there anything that we need to do to fix anything, right? And if And if you're already under contract on a property with a closing date, with contingency dates, with obligations that you legally have a requirement to meet, then kind of getting the cart behind the horse, so to speak. So make sure you get pre-approved in advance of making that offer. So what information is needed for the pre-approval? It's pretty straightforward. I mean, the lender is just wanting to look at your financial situation. So they need a full understanding of things like your income, your assets, your credit, right? Your income. So that would be like, what type of income do you have? Are you an employee and you get a salary? Which, that's as stable as it gets, right? A salary income is as stable as any type of income. Bonus, commission, overtime, is that come into play? Because if it does, those are kind of less stable. You might be a commission employee, but typically commission will go up and down depending on performance. So the lender's going to want to see a 2-year history, and they're probably going to average the 2-year history, or they might, if commission was lower last year than it was the year before, they're probably going to use the lowest, right? So this is something you need the lender to look at so that they can understand what your qualifying income is. So same with overtime, same with bonus. Any of those are typically going to be looked at differently than what salaried would. Are you self-employed? Right? Are you retired? Are you do you have capital gains or dividends or interest? So all of these things the lender is going to want to see, right? And the documents that you'll need to provide will be different depending on your type of income. So if you're W-2 and you're salaried, it's pretty simple. W-2s, pay stubs. If you do get commissions or bonus or overtime, the lender might want to see pay stubs from the previous year, because that's going to itemize out your commission and bonus income. If you're self-employed, the lender's going to want to see tax returns, whether it's your personal tax returns, or if you have an LLC or an S Corp, they're going to want to see your business tax returns. If you're retired, they're going to want to see like a pension statement, some sort of award statement to show how much you get, to show how often you're going to get it. Are you going to continue to receive it in the future? And so they're going to want to see all the income that's going to tell them about your specific type of income, so they understand exactly what type of income it is, how stable it is, how frequent it is, and is it likely to continue, right? And then your assets. They're going to want to see, where's the down payment coming from? Where is your closing costs coming from? Some loan types need you to have money in the bank after closing to be able to make sure that you can make a certain number of months worth of monthly payments on the mortgage after closing. So where is all that money? Is it in a bank account? Is it in your, is it in investments, a 401k, a brokerage account that you need to liquidate, right? Obviously a brokerage account is going up and down. So, they want to know, where is that money coming from? Are you getting a gift from a family member? All of that stuff. They just need to understand, where's the money coming from? Do you have it? Are you going to receive it during the transaction? What's the situation behind the funds? And then the credit. The credit would be your credit report. So they're gonna pull a credit report. It's gonna say, here's all the debts you've had in the past. Here's what you have now. This is, how timely you were on making monthly payments in the past. Here's the monthly payment associated with this debt. Here's the balance, right? They want to know all that stuff. They want to know, how good you are at paying your debts. That's really what it's about, right? How good is this potential buyer at paying their debts in the past, to then decide whether we think that they're going to do a good job at paying their monthly payment on the mortgage in the future. And so there's going to be a score associated with that. They want to know what your credit score is. That's going to come into play when it comes to what rate you get and what terms you can qualify for. They want to know, how much outstanding debt do you have currently? Specifically, what are the monthly payments, right? Because those monthly payments associated with that debt is what's going to allow you to make the monthly payments on a monthly basis on the new mortgage, right? That's going to come into play when calculating what's called your debt to income ratio, which is how much monthly payments do you owe combined with the new monthly payment on the mortgage. All of that divided by your qualifying income is your debt ratio. And that debt ratio is probably the number one thing when determining how much of a loan amount you're going to qualify for, because, they come up with your debt ratio, the monthly payment that you can afford on that new property, and then kind of back into it by way of the debt ratio. And then from there, they say, okay, based on this monthly payment that you qualify for, here is the loan amount that we think that you can qualify for in your situation, right? So the lender's going to look at all this stuff, and then based on that, that's what they're going to base your pre-approval amount on. And then obviously, if any of this can be changed, if you don't like the amount that you qualify for, then the lender will look at it and say, okay, well, is there any debts that can be paid off? Is there, can you get a gift from a family member? Can you come up with any other money? Is there any other way to do that? Can you liquidate retirement funds, even though you might not want to, right? But they'll explore every option to figure that out. And then income, do you have a raise maybe coming in the future that if you waited 3 months, you can qualify for more? So, are you self-employed and you're going to file your tax returns in 6 months and you had a way better year this year than last year? So, all of these things, the lender's not just looking at it, to say yes or no right now. They're also looking at it to try to give you advice on, hey, what can you do to get qualified? Is it better to wait 6 months, or can you qualify for the amount that you need now? So, and then once you're pre-approved, what do I do now, right? You've got this letter from your loan officer. You've talked to the loan officer. They went through all the credit, the documents, everything like that. Now you've got this letter that says, here's what you're pre-approved for. So if you haven't already, you're going to want to pick a real estate agent to work with. Typically, at least in my market in Illinois, the seller pays the real estate agent for the buyer. So there's really no reason not to work with a real estate agent in Illinois because you're not paying that agent. So you would want to choose a real estate agent to work with. They're going to basically set you up on like a search. So, they'll put the parameters in. If your pre-approval letter says $500,000, then they're going to set you up on a search for $500,000. If the search says you're looking, you're going to buy a single family home, they're going to say, okay, $500,000 single family home in, whatever communities you're looking at. And then you'll start getting properties. And then once you see a property that you might like or a few properties, then you're going to call your real estate agent and say, hey, I like 372 Main Street. Can we go see that property on Sunday? And right. So you're going to start looking at properties. You can then start communicating with your loan officer on properties that you're seeing. So if you see something that you think you might want to make an offer on, you can go back to your loan officer and say, hey, I have this property in mind. Can you take a look at it? Let me know what you think the monthly payment's going to be. There's mortgage calculators out there. So some of this you could be able to do on your own. But probably a good idea just to check in with your mortgage lender just to make sure that you're calculating it right. You understand what the monthly payment's going to be so that you're not making an offer on something that you might not be able to afford. And then once you have that property that you're ready to make an offer on, you understand what the payment's going to be, what your expected down payment's going to be, then you're ready to make an offer. And that would be the next step in the roadmap. So a couple things that you want to keep in mind after you're pre-approved is there's certain things that you don't want to do and there's certain things that you do want to do, right? The do's, obviously, so insurance, you're going to need insurance when you buy a house. You can contact your insurance agent before you even find a house and just kind of give them a heads up. You want to make sure that all the documents that your loan officer has asked for, if you haven't given it to them already, you want to make sure that they get that stuff. At this point, you've already done the pre-approval. So assuming that your employment and asset information is correct on your application, but obviously if anything were to change, you want to make sure that your lender knows that, right? If you change jobs, if you anything, if something happened, you bought a new car, right? You probably don't want to do that stuff, but if you did it and it's too late, then you want to let your lender know. And then just, be responsive and things like that. And then in terms of what you don't want to do, you really shouldn't be applying for any credit. You don't want to make any large deposits in your bank without talking to your lender, because that can just kind of screw things up. All deposits into your bank account, all money for the transaction has to be sourced. So if you have a large deposit that shows up on your bank statements, it has to be explained. And if it's something like cash under your mattress, then that's a problem, right? So talk to your lender before depositing any large money into bank accounts. Probably best not to have any inquiries on your credit. It's not the end of the world if you do, but you're going to have to explain why someone was inquiring on your credit, because the underwriter might think that you're taking out another loan, right? And so they want to understand, what loans do you have? And is there something that you just recently took out that's not on the credit report? If you've co-signed for a loan for somebody, that could be a problem. That's actually a question on the application. And then if you were to do that after the fact, then that could also be a problem, because, that will be considered your debt. That will go against your debt ratio. So don't do that. And then, it's best not to change jobs, but again, things happen, right? You get an offer that you can't refuse, but just call your loan officer first before you do that. And then a big no-no would be spending your down payment. Don't do that. You need money for the closing, for the down payment. If you don't have it, then I don't know what to tell you. So don't do that. Keep your money. You're trying to buy a house, so you need that money. So if you found this video beneficial, go ahead and subscribe. That way we can, keep feeding you with content that matters in this process. And I hope you enjoyed what you learned here. And certainly if you have any questions directly, you can reach out to me. Thank you.